3 years ago, Sarah got the call she had been waiting for since her mid-20s, Director of Product. After 7 years of grinding through associate roles, late nights, and passed-over promotion cycles, she finally had the title and the salary to match. Her compensation jumped from $87,000 to $124,000, a 43% increase that felt like the universe finally balancing the books. She remembers sitting in her car in the company parking garage after the meeting, hands on the wheel, not even driving anywhere, just sitting, thinking, this is the moment everything resets. No more calculating whether she could afford a weekend trip. No more declining group dinners because she'd already mentally spent that money. No more watching her savings account like it was a patient in critical condition. That was 3 years ago. Today, Sarah earns $147,000. Another performance review, another raise. Her income has grown by 69% over 3 years, a number that would make most financial advisors nod approvingly. And yet, if you sat across from her at a coffee shop and asked how she was doing financially, she would exhale slowly before answering. Her savings account balance today is nearly identical to what it was the month before her first promotion. She checks her bank app more often now, not less. The anxiety didn't disappear with the bigger salary, it shapeshifted. She works the same hours, she earns dramatically more, and somehow the hamster wheel spins at exactly the same speed it always did. She's just wearing nicer shoes while running on it. Here's the thing about Sarah. She is not reckless. She doesn't collect designer handbags or fly business class on personal trips. She doesn't gamble or spend impulsively on things she doesn't use. What she did was quieter, more gradual, and far more difficult to defend against. When the promotion came, she moved to a one-bedroom apartment closer to downtown, $750 more per month, but the commute was shorter and the building had a rooftop. Reasonable. Then the car situation. Her old Honda had 140,000 miles on it, so she financed something newer and more reliable, $310 extra per month. Sensible. A proper work wardrobe, because director means client meetings now. A meal kit subscription, because who has time to grocery shop? A wellness app, a better gym, a wine club that was genuinely a good deal per bottle. Every single decision made sense on its own. Every one felt like a natural consequence of getting to the next level. Together, they became a financial architecture that consumed her raise entirely and then quietly asked for more. Sarah didn't grow wealthier, she grew more expensive. And the most disorienting part? Her life doesn't feel 69% better than it did at $87,000. It feels roughly the same, just with higher stakes, higher fixed costs, and a quiet background hum of financial pressure that she can't quite locate the source of. My name is Phil, and I've spent an uncomfortable amount of time studying the gap between earning more and having more. Because for most people, that gap never closes the way they expect it to. If you've watched your income climb over the years while your savings stayed stubbornly flat, if you've ever stared at your monthly expenses and felt like the numbers shouldn't add up the way they do, stay with me, because I want to show you a calculation that most people never run, a way to measure precisely how much of your life you're exchanging for a lifestyle you've mostly stopped noticing. I call it your lifestyle inflation hourly rate, and once you see it, ordinary expenses stop looking ordinary. The core problem is a mismatch in how we perceive money, and it's not accidental. We think about income in annual terms. Raises feel enormous when described as yearly figures. Sarah's initial promotion felt like a $37,000 windfall, but we experienced spending in monthly installments. The $750 apartment upgrade felt like nothing against a $124,000 salary, just $750, practically a rounding error. Except $750 a month is $9,000 a year. Her $37,000 raise just quietly became a $28,000 raise before she finished unpacking. But here's where the calculation gets sharper. We need to convert that monthly cost into something more honest: hours of life. Sarah works roughly 2,080 hours per year. Her gross salary works out to about $59 per hour. But gross is a fiction. What she actually takes home, after federal taxes, state taxes, and all the rest, lands closer to $40 per hour. That's her real exchange rate. That's what an hour of her life produces. That $750 apartment upgrade costs her 18.75 hours of after-tax work every month. Across a year, that's 225 hours, nearly 6 full work weeks, not invested, not saved, not used to build anything, simply paid to maintain a nicer view and a shorter commute that she has completely adapted to. Sarah isn't paying $750 a month for her apartment upgrade. She's paying 225 hours of her life per year for it, and she made that decision in an afternoon without ever freezing it that way. The car isn't $310 a month. It's 7.75 hours per month, 93 hours per year, to drive a vehicle that gets her to the same meetings her old car would have. The gym isn't a wellness investment at $140 per month. It's 3.5 hours per month, 42 hours per year, to use equipment that is marginally nicer than what she used before. Add up all of Sarah's lifestyle upgrades, the apartment, the car, the gym, the wardrobe budget increase, the meal kits, the subscriptions, the dining creep, and her total monthly lifestyle inflation is approximately $1,850 above her pre-promotion baseline. Annualized, $22,200. Divided by her $40 after-tax hourly rate, 555 hours per year. That's nearly 14 work weeks, 3.5 months of Sarah's annual labor dedicated entirely to maintaining a lifestyle that she has largely stopped experiencing as an upgrade. The novelty is gone. The cost remains. There's one more layer that makes this worse, and it's the one most salary calculators leave out entirely. You don't spend after-tax dollars. You earn pre-tax dollars and then spend what survives. At Sarah's marginal tax rate, she needs to earn approximately $1.52 in gross income for every $1 she actually gets to spend, which means that $22,200 in annual lifestyle inflation requires her to earn roughly $33,700 in gross salary just to fund it. Her 69% raise over 3 years added approximately $60,000 to her annual gross income. Lifestyle inflation consumed 56% of it. Taxes took a chunk of the rest. The fraction left for actual wealth building is, in practice, close to nothing. This is what I mean when I say she's trading her life for her lifestyle. The exchange rate is hidden until you calculate it, but it's been running the whole time. Let me extend this forward, because the long-term picture is where this really becomes something you can't unsee. Imagine two people who start careers at 25, earning $52,000 per year. Both receive 3% annual raises over a 40-year career. By 65, they're earning roughly $169,000 in nominal terms. Marcus holds his lifestyle relatively constant, adjusting for inflation, but resisting the pull to upgrade with every raise. His savings rate increases steadily as his income grows. By the final decade of his career, he's investing heavily. Total wealth accumulated over 40 years, assuming 7% real returns, approximately $3.6 million. Sarah, who looks like most people, upgrades her lifestyle by roughly half of each raise. Better apartment at $60,000, nicer car at $75,000, premium everything by $100,000. Her income nearly triples, but her savings rate barely moves because her fixed costs kept pace. Total wealth accumulated? Approximately $850,000. The difference is $2.75 million. That's not the cost of a few comfortable apartments and nicer cars. That is the compounded cost of spending decisions made without calculating the exchange rate. $2.75 million and the additional years of work required to compensate for wealth that was never built. Every hour of lifestyle inflation hourly rate you pay in your 30s isn't just an hour. It's the compounded future value of an investment that was never made, the decades of growth that never happened. Sarah at 35, paying 555 hours per year to maintain her upgraded lifestyle, is not just trading those hours once. She's trading everything those hours could have become. Now, and I want to be direct about this, I'm not telling you to live like an ascetic. I'm not suggesting that all comfort is waste or that you should never enjoy the fruits of a career you've worked hard to build. The question was never whether to upgrade your life. The question is whether you're doing it consciously with full knowledge of the exchange rate, or whether you're doing what Sarah did, which is making a series of individually reasonable decisions that collectively construct a trap. Sarah didn't choose to trade 555 hours per year for her current lifestyle. She chose a nicer apartment. She chose a safer car. She chose a gym that felt appropriate to her new status. Each choice, made in isolation, felt like a reward. The aggregate, calculated in hours, was never surfaced until the damage was already structural. The psychological mechanism behind this has a name: hedonic adaptation. Behavioral economists have documented it extensively. Humans return to a relatively stable baseline of satisfaction regardless of external changes. Sarah was genuinely happier in her new apartment for approximately 3 months. Then it became her normal. The upgraded feeling evaporated. The $750 stayed. She is now paying 225 hours per year to maintain an emotional baseline she also had in her old apartment, just in a different building. The pleasure was finite, the cost is indefinite. That's the machine. Temporary satisfaction, permanent expense, and a lifestyle that keeps getting more costly without getting meaningfully better.
So here's how you actually fight back. Step 1 is the calculation itself. Sit down and list every category where your spending is higher today than it was 3 years ago. Every subscription added, every category where the baseline crept up. Total the monthly increase. Multiply by 12. Divide by your after-tax hourly wage. That number, your lifestyle inflation hourly rate, is how many hours per year you work exclusively to fund upgrades above your baseline. Most people have never translated their monthly expenses into hours. When you do, and you realize that your combined lifestyle inflation costs you 400 or 500 or 600 hours per year, hours that aren't building anything, just maintaining a status quo you've already adapted to, the abstract becomes visceral in a way that a monthly budget never achieves. Step 2 is the direct trade test. Take each inflated expense and ask one question. Would you work the required hours specifically for this thing? Would you work 42 hours this year specifically to access a nicer gym? Or would you take those 42 hours and use the basic one? Would you work 93 hours this year specifically for the newer car? Or would you rather have those hours back? When you frame it as a direct exchange, your time for this specific thing, the calculus often shifts dramatically from how it felt when it was just a monthly payment. Step 3 is selective downgrading. This is uncomfortable. It requires you to visibly reverse a decision you made in a period of optimism. But the math is unambiguous. Every $100 per month in lifestyle inflation you eliminate at a $40 after-tax wage gives you 30 hours per year back. Drop the premium gym for a basic one and reclaim 40 hours. Find an apartment $400 cheaper and reclaim 120 hours. Refinance or trade down on the car and reclaim 60 to 90 hours. These are not minor adjustments. These are months of your life redirected from obligations toward options. Step 4 is protecting the gap. This is the discipline that separates people who build wealth from people who simply earn well. When the next raise arrives, the default path closes the gap between income and lifestyle automatically, because there's always something to upgrade, always a new tier that feels earned. The deliberate path is to hold the gap open, name it, and direct it intentionally. A $12,000 raise, held flat against lifestyle, becomes roughly $7,800 after taxes, which, invested at 8% over 20 years, becomes approximately $37,000. 1 year of resistance, one decision to not upgrade, $37,000. Stack that decision over a decade, and you're looking at $350,000 in additional wealth built from raises you simply didn't spend. Sarah didn't fail. She followed the most natural path available to her, the one that feels like reward, that matches what success is supposed to look like, that every advertisement and social environment quietly confirms is correct. But she also didn't choose it. Not really. She drifted into a financial life that now requires her current income just to stay still. She has less freedom at $147,000 than she had at $87,000. Because she has more fixed obligations, more lifestyle to protect, and less ability to absorb a disruption or walk away from something that isn't working. She got promoted into a more expensive version of the same constraint. The number that matters isn't your salary. It isn't even your net worth. Not yet. The number that matters right now is your lifestyle inflation hourly rate, the hours per year you work for upgrades you've already adapted to and no longer notice. Calculate it. Sit with it. Then decide with full information and full awareness of the exchange rate whether the trade is worth it. Because you're making the trade either way. The only question is whether you're making it consciously. I'm Phil. I think about this stuff so you don't have to figure it out the hard way next decade. If this reframed something for you, hit subscribe. I'll see you in the next one.